All right, we're live.
I love it. Yeah.
Haven't seen anywhere yet.
I don't really have anything.
We'll get this kicked off in a few minutes.
Concert?
Is anybody heard?
It would say there's a number. It says currently 0, and I gave the link.
Are you sending it out to everybody?
Because I remember I asked.
Yeah, to everyone in the XCAL,
Everybody XCAL.
or like in the XCAL reminder list. You sent them. Yeah, the RSVP list.
So, me, you, Mike, and the kids. Okay. So you can ride with us in the van. Okay. So I don't know time, I'll look at the actual, when it starts, we can figure out when. Okay. Well.
And I think that's.
I'm trying to think of the best one. I don't have a best one like that.
This is from my.
Oh, I'm the only one.
I know, I looked over to you on.
It's all right.
Okay, so I can check comments as they come.
What? Man, you're gonna get stressed on here.
I know.
That's like one of the things they do, they do a lot of IT stuff, so. So, yeah, so it's like
Right. Oh, what was the title of the thing?
Yeah, human temperature. Yeah.
I said that, so I didn't remember.
I heard both of those things and I
Didn't
didn't
log
use
in.
it. Yeah, mine either.
I know, the whole house smells so she must have had all the gas.
Jason.
Yes.
Our server.
Because I guess the emergency was said that, like, once the levels are sound.
They are so good.
Affected.
No, I have a Samsung TV too and I still don't know how to do this because I don't use it. I haven't watched TV in like a year.
It was the worst feeling like not being there.
Yeah, I thought it just like,
People was just
yeah, I thought it just kind of pops up.
You want to download sharing
She's
mobile?
not nice, and she was.
I don't have any more memory in my phone.
Oh.
I don't know how to delete stuff. I am really not good with this stuff. That's why I did not bring any technology.
This is a smart thing. Smart.
Yeah, she was having trouble breathing. It was just, well, you know, it was.
It says smartphone screen sharing.
It was like she texted me.
So edit.
She was.
iPhone.
And then,
But it works with,
and then she's like, oh.
it totally worked with my Samsung TV.
And I just felt
It normally just takes over the TV.
horrible for her because she was a dog and stayed. And I get it, she loved her too.
I don't think it had to be like, I can track like.
We have to.
Actually download that. But I keep getting alerts that the phone is down.
2 people.
Yeah,
Do you know who they are?
it doesn't show me like the list.
So can you see me now? I don't see it.
Does he have the presentation there?
It's not a presentation, it's just a couple PDFs.
Oh.
So I can send it to somebody's laptop.
Yeah, because that's what the share link is nice for.
Is it ShareLink Pro?
Yes.
See if it works. I'll try.
So ShareLink Pro, you're basically just gonna.
Oh, yeah.
So is there anybody on there?
It's now free, so the only thing is on my phone I have to see if I can log in there.
Can you comment to the room?
That's what I'm doing.
Well, the process.
Next log. Once you see my
Can you read it
phone.
out?
Oh.
Tell me what.
So we want to try.
Like, enable to install.
Yeah. Send them the app.
And then I'll just activate it.
Maybe it works now.
Do you have another phone downloaded on Sharing Pro now, by chance?
Oh, no.
Yes, we should actually.
Let's get to log in.
Like decency.
Yeah, so once you get Sharing Pro app, this will just enter my code to take over the screen. It's just,
Let me forward you these PDFs.
Can you download ShareLink Pro on that phone? Yeah.
So,
Sharing Pro. Yeah,
Sorry, I'm not.
no, I'm Android too, I'm like.
Can't take you guys anywhere.
Here, I'm gonna do the screenshot.
Sharing, yeah, I'll take over from here.
They were so good. They're.
Can they hear us on the? On the
Yeah.
Okay. All right, if you guys can hear us, we're technical difficulties. We're going to get this thing rolling off, hopefully in the next 2 to 3 minutes. Thank you, guys. You can hear that? They can hear me, so can you hear that? Is this thing on? Oh, just now?
Yeah, on your stream there, so we'll visualize. So it's not like a big delay, maybe like several seconds. Yeah.
And then the last thing is, while I was doing that, can you get me on the Wi-Fi connection screen? Oh, okay, this is,
Thanks for your patience, everybody.
don't worry, I can talk fast or slow, doesn't matter.
Oh, so we drove a long way here.
Savor the lunch.
I can provide lots of fun facts and pictures or none at all.
and then back to the download screen. Oh, there it is, Sharing Pro, showed up.
You guys ordered lunch? Is there more?
No, yeah. We were kind of waiting to see.
We're good. Anybody dropped off, Jeff?
No, we're at 4 now.
Yeah.
Me, my mom, my dad.
My neighbor. My downstairs TV.
Oh, it's at 6 now. Went from 4 to 6.
We only had 2 people.
So-
If you got lunch, so 8 people are coming, they're coming.
Yeah, so,
That's what I was thinking, like maybe they got caught up.
so I was
mean,
gonna
that
say, when you're
happens,
done with
like-
your phone, I'll go on and so I can talk with the chat.
Did I send you the email?
I'll get your smash burger.
Smash burger?
Stop.
Do you like chips or fries?
I'll have fries.
Mirror screen. Right.
See, it's kind of like, I'm not really saying that.
Hey, look, I figured it out. Well, that's the code. I didn't realize that was the code. I thought it was gonna pop up.
Yeah, it
I'm
works.
done with technology, but like there's common sense sometimes. Look at me figuring it out. No promises on how long this will last.
Should we kick this off?
Sure. Are you introducing me or am I introducing myself?
Well, I'm going to introduce you, of course. But first, thank you guys for joining us online and in here in this packed house. They can't see, so I'm going to say packed house. We're going to go over some investment stuff today. Thank you guys for joining us. Lindsay Veleber with Edward Jones is joining us. She's a 2010 graduate of the Pennsylvania State University, Penn State baby. Played rugby, 2 national championships, so she has that competitive edge built into her. So it's awesome for finance and in her field. From Pennsylvania, awesome dog named Bo.
My boy.
That's my boy Bo. But before we kick off, before Lindsay kicks off, what I want to ask you guys, and if you guys can see this online, I've got a quick question for this packed house and for the folks online. As a closing gift, if you were buying a home, getting a closing gift, would you prefer a handmade charcuterie board? Did I say that right?
Mhm.
I've been practicing. A handmade charcuterie board was made by a good friend of mine, has the family's name right there. Or do you think something like a homeowner's binder that has all the information? Has some pockets for like the appraisal and some important documents. I think this is kind of cool too. I'm kind of going back and forth. So if you guys can comment in there and let us know what you guys think, and what do you guys think here?
I like the binder personally.
Like the binder?
Like for first time home buyers, I like that.
Yeah. How do we think?
Like the board.
The board?
Yeah.
What do you guys think? Board?
I don't like the binder, my wife would like the board.
So both? Here's the only both? What do you guys-
Board.
Board?
How hard is it to put one of those together?
It comes together. It comes like this. I put it together for you.
Okay, that's what I mean. Like, okay.
Well, when I say I mean Josh, but.
I know, Josh is always the one being nice.
Thank you, Josh.
Oh, you're welcome.
So let us know, and that's some good information. So now I'm going to hand it over to Lindsay to take over.
You know, you could just give people the option, but then you sort of spoil the surprise as to what you're giving them.
Right. I like the surprise aspect.
I know, but just saying. You
That's
take
actually
all the
a good point.
guesswork out
Good point, too.
and just give the people what they want.
And that's what I'm all about, giving the people what they want.
Well, anyways, thank you for the introduction.
Yes.
So I am a financial advisor with Edward Jones. I have been doing this for 12 years. So I've got lots of experience in all sorts of market conditions. Most of that time, the market's quite frankly gone up. But today I want to talk about what is the market exactly. When you hear people talking about the market, what is it? What is it made up of? What are they even talking about? How does that relate to you as an individual investor or a small business owner? I'm not sure exactly who's in the audience, but let's just assume there's at least 1 or 2 of you that also own a small business. And then, you know, what should you be doing now? What's going to be happening today, a year from now, and how should you be looking at your investments to adjust to the current situation or not adjust? So what is the market? So when you guys think of the market, what do you think? What do you think that means? What do you think it's referring to?
Stock market.
Stock market.
Stock exchange, Dow Jones, NASDAQ, all that fun stuff.
Right. So there's 3 major indexes, right? That the media refers to as a market. So you've got the Dow Jones Industrial Average, you've got the S&P 500, you've got the NASDAQ. Any idea of how many companies are in the Dow Jones Industrial Average?
200.
500. The Dow Jones Industrial Average, everybody would be, nobody would win. If it's Price is Right rules, right? The place is about going over. But it's 30 companies. There are only 30 companies in the Dow. S&P 500. This one's a little easier. 500 companies, right? What about the NASDAQ? 3,700, give or take. Depends on the day. That one fluctuates. So, oh. Okay, noted. I'm going to put this down so I don't make anybody dizzy for a minute until I'm actually referring to this. So the NASDAQ too. Does anyone have any other thoughts when you think about the NASDAQ?
Technology.
IT technology.
Right, so that's known as like the tech index. So the NASDAQ is actually a global index. So it's made up of some companies that are also headquartered, outside of the US, which is different from the S&P and the Dow. Those are both domestic. Those are only companies that are here in the US. So NASDAQ, global, right? And everyone thinks of it as tech because it is made up of half to more than half of tech. It's about 51% technology companies right now. The S&P, again, is the 500 largest companies in the US that are publicly traded, right? That's a big factor to consider too. You have to be able to purchase shares of them on the open market. And did any of you know, well, do you think that the S&P or the NASDAQ or the Dow are made up of equal shares? So 30 companies in the Dow. Is each company representative of 1/30th of that index? Got some people shaking their head no back there. That's right, they're not equally weighted. So what does that mean? That means that certain companies make up a larger percentage. So when the market goes up, when the market goes down, whichever market media is referring to in that context, it could be and is likely driven by maybe even just a handful of companies. So, if you hear the market's really up that day, well, maybe it's just Apple that's really up that day. Because Apple makes up a large portion of one of those indexes. In the NASDAQ, let's see, it is, and I checked the latest data because it varies, right? Because the weight of the index depends upon the price of the company and the market capitalization. So it's not, always the same. Apple doesn't always make up 10% of the S&P 500, for example. Let's see. Here we go. So the Dow. Yeah, the Dow Jones Industrial Average, the top 10 companies make up 54%. It's not that astounding. But how about the NASDAQ? 5 stocks out of 3,700 make up 47% of the index. Wow, what's the point of the other, 3,695? And those are some of they call them mega cap stocks, right? We got Amazon, Google, Apple. I think Facebook actually is one of the other big ones up there, though that one might have fallen down. It's now referred to as Meta. Either way, just wanted to give you guys some perspective, basically, of how when you hear what's going on in the market, it's very likely going to be more so what's going on with 20 to 25 companies overall. So how does that relate to what's going on right now, right? So we hit a bear market. What's a bear market? Anyone know? How much? So a bear market's defined as going down 20% from the high. Okay, we hit a high in January early on, and then it has fallen 20% since. It's fallen more than that, give or take the day, right? But that's what it's referring to. What's a recession?
2 quarters of negative.
Sometimes. It's actually not specifically defined. Isn't that fun?
Oh.
Yes. So we've got, and I have a picture for this that I have for myself. It is the National Bureau of Economic Research that actually decides whether or not we're in a recession. And there are no specific things, there's no specific thresholds or numbers that they look for in order to indicate whether or not we are in a recession. And
Politicians can decide whether we're in a recession or not.
kind of, I mean, generally, they're looking for an overall decline in various parts of, economic growth, essentially. But it's not an exact science, right? So it's a general across broad factors of data or broad data sets, and that data has to come out, and then they have to analyze it. And so by the time we're in a recession and it's been declared as one, it's already happened, right? So it's like, the recession is already there until they've actually called it a recession.
So what part of real estate is a portion of that factor? Do you have an idea? Because like a lot of times when you're in a housing recession, like what is the driving, that's a driving force for a recession, but do we have any idea on what?
Like how is real estate factored into,
Yes,
or like how does it weight?
exactly.
So to give you I don't know real estate from that particular question. It's GDP, how growth is, gross domestic product, which is, how a country's growth is measured essentially. 70% of GDP in the US comes from consumer spending, right? So consumer spending, purchasing a house, is related to like household income. It's related to jobs. Our jobs market is at a historic low, like of all time. It's near historic lows of all time, meaning the unemployment rate is what I mean by that. So, that's a good thing. And, generally, are we going into a recession, right? Like that was kind of the gist of like, so we hit a bear market, but does a bear market mean a recession, right? They're not the same thing. Sometimes people will use them inaccurately, like as, synonymous for each other, but they're not. So, a bear market, again, 20% off the high. A recession, well, it's not clearly defined, but it's a general overall declining in growth for several months. That's kind of how they've defined it. So it's vague. But, does a bear market always coincide with a recession? The answer is no. 70% of the time it does, but not all the time. So, you hear bear market, people freak out. They might, quick want to sell, whatever they're invested in, because you want to minimize losses, right? Well, that brings me to my actual first, we'll call it a slide. I saw that if I go like this, it goes bigger. Here we go. So missing the best days. This is why we don't time the market. So this particular market, we're going to use the S&P 500, right? 500 companies, US. It's a pretty good, it's a broad indicator. So this goes back to I think it's 1980, this one is. Yeah, January 1st, 1980. So if you stayed invested the entire period, putting your money at $10,000 in the S&P 500, you just you stayed invested, you did nothing. Your money would now be worth $980,911. The average return is 11.8%. I think most people in this room would be happy with that, right?
Yeah.
Except those years that you're like, well, so-and-so got 25%. Wow, okay. But they also, maybe didn't go down as, maybe they're going to go down 50%. Well, you might only be down 30%, right? So perspective is important. All right, so what if you missed the 10 best days in the market from 1980 until now? Well, you lost about 2% of total return. So now your $10,000 is only $437,000. You only missed the 10 best days since 1980. What if you missed the 20 best days? What happened? Can anyone see that here?
Yeah.
$254,000. So much for that million, right? You missed the best 30 days. You're all the way down to 158,000. You missed the best 50 days. Your $10,000 is now $70,000. And you've been invested for 42 years. We're in 2022.
Yeah.
Do the math, right? So this is why we don't time the market. So if you're invested, you stay invested. Because if you're trying to sell your investments just to get back in at a certain time, well, you've got to pick what you should be selling, when you should be selling it, and then you need to decide what you should be buying when you get back in and when you should be buying it. Can anyone make those 4 decisions right all the time? The answer is no. We would have so many more billion and trillionaires in this world if anyone could do that, right? So if you're wondering what you should be doing, most of the time the answer is nothing. Now that doesn't mean you should ignore what you're currently invested in, right? Like that's the reason why you should, conduct periodic reviews. If you're not, there's a reason I have a job. I'm a financial advisor, right? So there's a reason that people work with me. It's because I help them review what they've got, in their investments and help adjust it as needed, right? So here we go. This is putting our market declines in perspective. This one's a good one too. Here we go. So how many times, this also goes back to, this actually goes back all the way to 1928. So how many times has the market dipped 5% or more since 1928? Yeah. 319 times. It happens on average 3.5 times a year. What about a correction of 10% or more? So the market goes, 10% off the high. Happens on average once a year over that whole time period. What about 15% or more? Well, over that whole average, it's a half day per year, right? But that's still, happening once a year, every couple of years. That's still, it should be expected, not surprising, right? You should actually expect that to happen in the market. A bear market, right? A bear market, 20% or more decline. So that has happened 26 times since 1928.
Where are we this year in the S&P?
I have those numbers later on. I checked. I think S&P's down 18, NASDAQ 13. No, NASDAQ's higher. I'll double check. One of them's 13, one of them's 18, one of them's 26. NASDAQ's down the most still, I believe. Yeah. And so, like the mean number of days. So how long did it last? So bear market happened 26 times since 1928. How long did it last? 289 days was the average. Okay. So call it a year. A year of less than desirable statement opening to see where your account balances are, right? What's the average percent that it's declined? 35%, right? If you guys remember March of 2020, something called the start of the pandemic, right? There was a market decline that hit, the mid 30% range. S&P 500 was down mid 30% for a hot minute, right? It was only 5 months of a bear market, and then it recovered. So markets, oh, that's right, it is. Sorry about that. There we go. If you give things a long enough time frame, they tend to sort themselves out. That can be applicable to almost any situation in life, but it includes your investments. So the main idea is you just want to be invested appropriately to begin with. Let it ride, monitor it periodically. Don't make any knee-jerk reactions. Just keep the your long-term goal, whatever the purpose of that money, keep that in view. And don't open your statements if it gives you too much stress. I have many clients that just tell me, I know the market's down because of the news. I'm not going to open my statement. Just let me know when I can look at it again. Okay, I can do that. Let's see. All right, so let me go back to recessions. I wanted to give you some more data on our bear markets. Want to do that? Here we go. Treasury yields. Here we go. Right, average bear markets, 34% is the down off of the high. It's defined as 20% or more. So here's the period of time. So the green or the purple is a bull market, right? That is going the direction we like for it to go. And the red up here on the chart is the bear market. What does anyone notice about the chart?
More up and down.
Yeah, much more.
That's why we invest, right? Because your investments are going to be up more than they are down. And that's how you make money too, because they're up more than they are down.
Is
To
that,
put it very simply.
does a cryptocurrency look like that?
I don't follow cryptocurrency.
Oh, you don't?
This is totally irrelevant of cryptocurrency.
Gotcha.
Yes. So the bull market, let's see. See that figure up here? An average bull market, 167% return. 167%. So you decide, right? Are you okay stomaching down 35%, knowing that 167% is coming, as long as you just wait long enough?
Yeah.
Yes. Yeah. So, who likes a good sale? Right? How exciting is it to buy a really good quality product or even get a really great quality service at a discount? It's pretty awesome, right? So that's how you have to think about investments too. There's going to be periods of time where certain investments are discounted, they're cheap, they're on sale. That doesn't mean they're of poor quality. That doesn't mean they're bad. That doesn't mean all of a sudden they're going to stop earning money or never earn money again, or that their earnings are not going to grow. But there's going to be periods of time in which, a sale exists. Could it be supply and demand? Too much supply, too little demand, you put it on sale, right? Well, you got to get rid of the inventory. So same things happen in our markets. There's too much supply, prices fall if there's not enough demand. There's too much, demand is high, supply is low, prices go up. What's our inflation caused from right now? There's too many dollars chasing too few goods, right? And that's being exaggerated by the issues in the supply chain, log jams, right? And so that drives prices up.
Next question. So one of the other trends I see is that it seems like things gradually build and then completely nosedive into a bear market. Is it,
Does look like that.
yeah, is it usually like a sudden impact like that based on like external events or things, or does it ever trickle downward like for a while?
Well, so the x-axis here, 1946 to 2020, actually it ends at 2020, December of 2020. So if you zoomed in on any part of this, it's still going to look pretty quick, but not quite as dramatic as a straight line down. It usually does, if you think about January to now, I can pull up a chart, it just kind of shows it's kind of a gradual down. It hasn't felt gradual, right? But it's all about the time frame. So it's also going to look more dramatic because it tends to fall quickly relative to how it climbs, right? Because bull markets last longer, bear markets last shorter. Yeah. There we go. That brings me to, here we go. This is one of my favorites. One of my favorite pieces of paper / PDFs in this case. So crisis events, and then now we're talking about the Dow Jones Industrial Average. So what happened when Germany invaded France? What was the initial percent change down? Down 17%. And then the rest of the data points show how many, like the days after that happened, what did the market do? So 22 days after it happened, well, all of a sudden now the market's only down 0.5%. 2 months after it happened, no, now it's up 8.4%. Then you've got, let's pick some other ones over here. Nixon resigns. Oh, similar reaction, 17.5% down. 22 days later, still down 8%. 2 months later, down 5.5%. Oh, but Less than a year later, up 27%. Let's pick another one. Financial panic of 87. Ooh, Black Monday. Right, October 1987. Down 34.2%. But gee, so quickly, 22 days later, up 11.5. And then almost a year later, up 24%. Right? Let's see. What does this tell us?
Market's always gonna come back.
Also tells us market does not like uncertainty. Right? Market doesn't know how to price in this stuff because it was unexpected. So the market's going to react quickly, right? And then it's like, oh, okay. After you give it enough time, it sorts itself out. So when you hear that the market's reacting negatively quickly, you think opportunity, not, oh no, I should sell. Ooh, what should I buy? Right? So if you have money available, these are buying opportunities. Now, there's always a buying opportunity. Doesn't matter if the market is up or it's high, right? Well, that might mean it's just those 5 big companies that are up, right? Well, don't buy those then, right? But there's always an opportunity. It's just a matter of, what is a good price right
Can you go
now?
back that? I would probably a dumb question. Like, for instance, go down to the bottom for easy math, that last one. So the India, Israel, Lebanon bombings,
Mhm.
knee-jerk reaction, -3% down. And then up, a month later or whatever, up 5. So is that 8? So it actually came back 8%?
Yeah, let me just, I think so, but hold on, let me check the table. Percent change in the days following the crisis. So it was how much is it up from where it,
Went down?
Yeah.
So if it lost 3, then it was up 5, it actually came up 8.
yes.
Okay.
Yeah, I think we're reading it right. Regardless, it's still positive.
Right.
You're either up 2% or you're up, 8 from there.
That one's down 36 and up 60, so actually up 96.
The days following following the crisis. I think it's after. So I think it's a net. Meaning, so first confirmed coronavirus case, here we go, down 36%. After 22 days, the market recovered almost all of that, but not quite. That makes sense. So it's a net. So you start with the first one and then you add the next one to it. Yeah. So, because that coincides with overall, 126 days, we were actually back to positive. Unless you were an airline or a cruise line or some of the other industries.
Is that US or world? US.
This is the Dow. So yeah, it's just looking at the Dow Jones Industrial Average, which is 30 really big companies. Yeah. So how does this relate to you guys, right? And your investments, your portfolios? So the first thing that you have to think about is what is the purpose of the money that I've got in question, right? You've got investment saved, so is it for retirement? Is it for a different goal? Is it for a second home at some point, right? So you've got money set aside. You have to define the purpose of the money first. What's the goal of that money? Is this a goal that's long-term in the future? Is this a goal that's coming up soon? Okay, so the way that you should be invested is different depending upon the time frame of which you're about to use that money and how long you're going to be using that money for. So we'll use retirement as an example. Retirement is, hopefully for all of us going to be a long period of time, right? And so you don't just save your money up and then all of a sudden turn it all into cash and then live off the cash. Because as we all know, cash in our bank accounts over a very long period of time has not earned us more than a couple dollars in interest, right? There's something in the finance world called the rule of 72. Has anyone heard of this before?
Yeah.
Rule of 72, really fun thing to surprise everyone with. It's just a little fun fact for us nerds. If you earn 1%, your money doubles every 72 years. Woohoo! That's so exciting. Wow. But if you earn 7.2%, your money doubles every 10 years. That's better, right? If you're in 10%, your money doubles every 7.2 years. So those are, odds are a lot better if you've got your money invested versus in cash. It's the moral of that story. However, if you've got a short-term need, you've got a one-time expense that you know of, maybe it's like a wedding or a vacation in the next 1 to 3 years, that should be in cash, or some other very conservative investment that is either barely or not going to fluctuate in value at all. Maybe a CD, certificate of deposit. When a wedding is, when payments might come up, you can put your money in a CD, maybe it'll earn a little bit better than your bank account. That's the reason why you might do that. And the CD would mature then in time to use the money, right? What about if you're still working? How much should you keep in an emergency fund? It's a fun question because everybody has a different answer.
6 months.
3 to 6 months. I always tell people it depends upon how secure you feel in your job, right? That's where your income's coming from. How easily can you get another job paying, what you need to make in order to pay your expenses? If you have really good job security and you are confident in that, then do 3 months, right? You don't have to do 6 months, but if you're like, well, I'm really going to be picky about, the next job I take, and if I happen to leave my current one or, by my own or other people's terms, then I want to give myself 6 months to really get, the right next opportunity for me. Well, then do that, right? If you are retired, how much money should you have in an emergency fund? The answer is different. So I tell people if you're preparing for retirement, you should have 2 years worth of the cash. You should have 2 years worth of cash that's equivalent to the amount you'd be pulling from your investments to support your income. So in retirement, someone might have other sources of income, Social Security. Maybe there's a part-time job that they're doing for fun in retirement, right? That's a source of income. There's a lot of rental income, right? Somebody might have a rental property. So we'll call those non-variable sources of income, theoretically, right? That's money that coming in. And then maybe you need more money than that, though, to meet your expenses in retirement. So that extra money is going to come from your investments. So whatever amount that you need to pull from your investments to support your income in retirement, you take 2 years worth of that and have it in cash or really conservative investments like CDs. Why? Because if you hit a bear market or a recession, the day you retire, you don't want to change your plans, right? Who wants to change their plans because of something that they can't control? Nobody, right? So if you plan for it and you've got what you need in place, you want to have, cash available. You also want to have access to a line of credit, whether it's, home equity line of credit or a personal line of credit, just in case, just have access to it. Those two things are going to keep you in control of when you do decide to stop working full time, right? Any questions on that? Surprising. What else should you do if you all of a sudden decide to retire or make a job change? And now we're in a recession and everything's doom and gloom. Well, like most people, you should be responsible about where you're spending. Can I cut spending anywhere for a little bit temporarily? All of us can. All of us can, right? So, do your part. Focus on what you can control. You can control what you spend your money on, your discretionary money, right? So cut back a little bit, because the more you can preserve your investments, especially in the beginning of your retirement, the longer that money is going to last, the more flexibility you're going to have. Now, I'm never a proponent of somebody living as if they are poor now just to be happy and rich and fat sometime in the future, right? Like that is not my personal philosophy. I do not support that. I support, planning the best you can with a lot of unknown variables, because that's what it all is, right? There's no exact science to it. But you just do the best you can, but you have to be aware of it, right? You've got to be aware, like, where's your money going right now? Like doing a monthly budget. One of the biggest factors I have people do before they're ready to retire is you got to run a budget. Like, where's your money going right now? You don't want to retire and all of a sudden realize, like, oh, I thought I was only spending this much. I'm actually spending this much. You don't want to retire and all of a sudden feel like you can't have the same spending habits. That doesn't feel like a fun retirement, right? Like, you want to retire and continue your lifestyle and just not be going to work every day and be doing what you want instead. So you have to actually know where your money's going, know where you're saving your money until then, right? That's the accumulation phase. Until you retire, you're accumulating your money. Are you accumulating it in the best places possible? That's the tax strategy side of it, right? Like, so there's different places you can save your money that will be better for you now and in the future from a tax standpoint. Should you save all of your money in tax deferred accounts? So, you know, if it's like a 401k plan, an IRA, you know, the real answer is, like, you know, it always depends on your actual personal situation, right? Like, so I can't give people broad advice. It's like going to the doctor, not opening your mouth, saying a word and saying, well, what's wrong with me? What should I do? Right? Like, you know, the doctor can't give you advice on that. Just like I can't give people broad advice either. But I can tell you that, you know, saving all of your money into one money type of account, such as a tax-deferred account, a tax-free account, a taxable account, is not generally the best strategy. Right? If you save all of your money in a tax-deferred type of account, at some point the IRS wants to get those tax dollars from you. So right now, when you turn age 72, nobody in here looks nearly close to that age, other than not calling you out. You're looking fabulous, Angela. I know, Angela.
My age. Grateful to live with she.
She is not 72. She looks like she is, you know, at least 10 to 15 years younger than she is. Anyways, so at age 72 right now, the law exists that you're forced to take a certain percentage out of tax-deferred accounts, right? So all of a sudden you've lost the control of how and when you're taxed. Well, that kind of stinks. You know, you've been riding along in retirement maybe for, you know, 5, if you're lucky, 10 years at that point. And then all of a sudden you're like, oh, wait, the IRS is making me take money out of this account and I have to pay taxes on it? Yes, the answer is yes, that has to happen. What happens if you don't do that? They penalize you 50% of the value of what you were supposed to take out. Yeah, that's not a good tax rate either. So the moral of the story is, if you're about to make a really big decision, like resigning, retiring, anything else that could affect your personal and financial life dramatically, you should be planning ahead for this, or at least sit down. You know, people always come to me during those times. Okay, I'm about to do this. Can I? I'm about to this. Should I? Talk me out of it talk me out of it if I shouldn't be doing it. You know, what should I be doing better? You know, what can I be doing better? How can I give myself more flexibility? Right? So these are the things that, you know, it's all personalized for what the purpose of your money is, right? What other questions do you have for me? Oh yes, inflation. Let me bring up one other thing. Current markets, investments. Where are the opportunities right now? Well, energy stocks are not really cheap. That has been the best performing sector in the market this year, 40%. So that's good if you've owned energy stocks. Good job. Maybe sell. Maybe. So individual stocks, look at individual stocks. Look at mutual funds that are made up of stocks. Prices are good right now. Could they get better? Of course. They can always get better. But you don't want to miss out on good, hoping for great, and then all of a sudden, great never happens, and now you've lost on some of that return, right? So that comes back to market timing. Buy in when you know prices are good. Don't wait for, buy in on the sale. Don't wait for the clearance. The clearance might not come. If the clearance comes, don't worry about it. Don't kick yourself. Whatever. I got a good price, and I know that price is going to get way better, and I'm going to make money off of that after buying in on that price. And that being said, if you have more money available, buy more on the clearance, right? But you want to know what you own. You want to know what you own. Don't buy things that you don't understand. You'll be less likely to keep owning it when they go down, right? If you don't understand why it's going down, that's not a good sign. If you don't understand, like, Pepsi stock, right? Pepsi stock. Well, the price of Pepsi stock fell. Well, why? Market cycle of demand, right? Pepsi is a consumer staple, investment, supply and demand. Goes up, it goes down. It's consistent though. You give it enough time frame, their stock chart looks like this. Right? So you're probably not going to sell your Pepsi if all of a sudden the price goes down 20%. Like, now people are still drinking Pepsi. And Pepsi owns a zillion other drink brands now too. So, but if you own something and you're like, I literally could not tell you at all what that company does, where they get their money from, then don't buy it. You asked about crypto earlier. I don't follow crypto. I don't own crypto. I don't care to understand it. That's my personal preference, my personal decision. I understand there's technology behind crypto that has potentially a lot of value. I get that part, but I'm not a currency trader. Currency is speculative. I like to own things that I perceive have real value right now and that I understand. So if you understand crypto and you're happy to ride the up and down, that's your choice, right? That's your money or your choice. Sorry, I'm gonna put the phone down again. Make everybody dizzy if I keep moving it. If you don't want to deal with individual stocks, what's the other option? Mutual funds, right? A mutual fund has a professional team of managers that's what they do. They decide what companies to own and how much of it to own and when to sell it, when to buy it. Not all mutual funds are created equal, right? So again, you got to at least, do enough due diligence as an individual investor who's putting a lot of money, like your life savings, into something, and ask enough questions, or team up with a professional to feel confident that you're owning a quality investment, and ask about the selection process. Well, how did you pick this? How do you monitor it? Things like that, right? Edward Jones has their whole research department about mutual funds. We go and visit mutual fund headquarters. We speak with the management. Anytime the management changes, we put it under review. Well, do we like the incoming management? Do they have a track record? What has their track record been? All of these things, right? So that's the point where if you don't want to deal with individual stocks, you don't really have an interest in it. You don't plan on watching your investments on a semi-regular basis. Well, maybe a mutual fund is more appropriate for you. And if you really don't even want to deal with looking at how to pick or how to monitor, because again, you're focused on your job, your family, your friends, you don't want to deal with that. Well, that's when you work with somebody, and that at least somebody's helping you watch, but it doesn't mean that you can't pay attention either, right? I partner with people. I don't just work for people and tell them what to do. We partner together because I can't tell them what to do unless I know more from them, right? What are the other opportunities right now? So some stocks are very, stocks that have outsized growth potential is going to be good for inflation, right? Stocks that can absorb the increased cost of goods through, charging increased prices, for example. So manufacturing industry, building materials, right? Well, they just pass along those increased prices to us, the consumer. So the company is not so in such a bad position because there's demand for what they do, and they can pass along whatever they've lost in the cost of goods through an increased price. Those are good opportunities right now. What's not a good opportunity right now? Probably some things that are discretionary in nature. Could say some travel related companies. Doesn't mean it's a bad investment long term, but just maybe not a near term. You might not, in the next year or 2 years see, an awesome improvement in price. It might take a little longer. What else? Let's see. In companies that pay an increased dividend. What's a dividend? Anyone heard of that before?
When the company gives their shareholders some of the cut.
Yeah. So say you own, let's just pick McDonald's. I don't know why. Let's pick Starbucks. They pay a dividend. So Starbucks, you own 100 shares of Starbucks stock. Their dividend is like 2.8% right now. So for every 100 share, for every one share you own, let's say it's $100. It's not, but it's close to that. So say it's $100 a share, and for every one share you own, it means you get $2.80 a share every year. No matter what the price does, though. I was just doing that for easy math. So if the price goes all of a sudden to $70 a share, guess what? You still get your $2.80 a share. Well, that's a pretty cool deal, right? And it doesn't even matter what the price does. So they're literally just giving you a piece of their profit for owning some of the shares in their company. Now, there's a lot of companies that actually have a track record of increasing that dividend on a regular basis, and also just paying a dividend. So a dividend's not guaranteed. The company can decide they're going to cut the dividend. They're going to no longer pay the dividend. So if you're going to do individual stocks, it's kind of a cool thing to see, well, do they pay a dividend? How much? How long have they paid it? How often have they increased it? So a company that continues to increase what they're paying you is also a good way to keep in line with inflation or protect yourself more so against inflation, because that income is rising that you're getting, right, over time. Bond market's fun. No, it's not. Bonds are really boring when the stock market's going up, right? Bonds are really boring. You're like, why do I even own these? I have so many clients. Why do I own these? They're doing nothing. Just wait for it, right? You own it because when the stock market goes down, typically the bond market either doesn't go down as much, it won't go down as much, or it stays relatively unchanged. There's times where the bond prices go up. That's when interest rates are falling. When interest rates are rising, bond values go down. Hence why our markets right now, people are really upset because stock prices fell and the bond prices fell. It happens. Short periods of time, these things happen. Supply and demand, interest rate changes, right? But given a long enough time frame, it'll settle itself out. But bonds, what can you do in the bond market that'll help you with inflation? Well, there's Treasury. Treasury, totally blanking on the next word. They're called TIPS. They adjust when interest rates adjust, which means if you own it's a Treasury. Does anyone know the second word?
T-bill?
Yeah.
No.
Well, yeah, TIPS, T-bills, yeah. So it's basically when the rates go up, these your principal adjusts up, and so you get more interest from this investment. But on the flip side, if rates tick down, then your principal ticks down, but it never goes below your original principal investment that you put in. So that's something to look at. It basically, it's inflation protected securities, Treasury inflation protected securities. Yes, thank you. Anyways, there's also the I-bonds. I don't sell those. You have to buy them straight from Treasury Direct. They are paying something like 9.6% right now. It's a pretty good deal. It's a pretty good deal, but you're capped at how much you can put into it. And there's a couple other little things, but for a portion of your safe money or money that you're going to need in like a couple of years, it can't be less than a year because you get penalized if you take it out. You just don't get all of your interest. But anyways, that's something to look into too. It's a good spot for, again, they cap you at like $10,000 per person. But it's still, $10,000, 9.6%. You can't get that in the bank, right? And then last but not least, in the bond market, there's also, you want to make sure you've got high quality bonds. What does high quality mean? It means that the ability of the bond issuer to pay its bond holders is high. So they are healthy financially. A high yield bond is typically a riskier bond. It's paying you a better interest rate, high yield, higher interest rate. Investors tend to like that, but just be wary of chasing the yield, right? Because the underlying quality of that investment might not be so good. But at this point, higher quality bond, mutual funds, individual bonds, they can give you at least a decent interest rate. And if you own it in the form of a mutual fund, that'll adjust up with the interest rates too, adjusting up. So there's areas of both the markets, stocks and bond markets, that you can still be invested in that are not going to be detrimental to you and that will help during inflationary periods, is the moral of the story. One other area of opportunity for those that are okay with taking a little bit of additional risk is emerging markets. They're nice and cheap right now. What's an emerging market company? It's a company that's headquartered in a country that is considered an emerging market. Let's see, we've got Bangladesh is one of them, Poland is one of them. Just some random, not random, it's the country, but like things that like countries you might not think of as like an emerging market. But if there's a company headquartered there, owning those type of investments in the form of a mutual fund is likely a good choice, just because then you've got those professional managers that are, really going through all of those companies available in a completely different country and figuring out which ones they should be invested in. But those types of investments have a pretty good opportunity for a quick rebound, is why that's an opportunity. But you don't want to put like 100% of your money into emerging markets, right? What does diversification mean? Which brings me to my last point.
That spreading your money across
different asset classes, right? So what's an asset class? So a large company based in the US, large growth stock, large value. It's a large company based in the US that pays a dividend as the primary value in that company. Large growth, large company based in the US that is, you own it because of its growth potential. It might pay a dividend, but that's not the reason that's not the primary reason that you own it. And then you've got small growth, small values. These are small based upon market capitalization, based upon how many shares are available in the market for you to purchase. So smaller companies right now, not a really good opportunity, because smaller companies cannot typically adjust to inflation as well. They don't have the size behind them, the pricing power per se, to adjust to inflationary. Now that's a general statement, right? But if you're picking based on asset class, large growth, large value, it's a better place to be right now. It doesn't mean don't be in those places, but if diversifying is purposefully not aligning your investments to grow as much as the market or go down as much as the market, okay? So you're going to hear on the news during, really positive market years, oh, S&P is up 25% this year. And then you're going to ask your financial advisor, well, why am I only up 15%? The market's up 25%. What are we invested in? Well, we've chosen to not put our money 100% into the S&P 500 index. Because guess what? When the market's down 35%, right now 18 to 26%, depending on which market you're looking at, the idea is you will not be down 18 to 26%, right? So you are purposefully missing out on all of the upside because you will purposefully not capture all of the downside, right? That's the point. That's the point of spreading your money amongst different types of asset classes. And when is that the most comforting? In retirement. Because the reliability of your return in retirement is arguably more important than the return itself. Because when you're retired, you just want to know that you can rely on your investments to continue pulling income from them to support whatever you're doing in retirement. You don't want to have to worry about, big ups and big downs. That's not the whole, goal there, right? Unless you plan to retire and focus solely on the stock market in your retirement as your hobby, right? I don't really know anybody like that, but they wouldn't work with me anyways. Let's see, what other questions are in your mind? That's kind of the gist of what I wanted to share with you all today. And the goal was to give an overview of what is the market, kind of bring some more fact to the floating myths around there. Hopefully give you some actionable items for yourself to consider. And then also, other things to make sure you've got in mind prior to making a big decision for your own personal life.
Could you shed some light on what causes a stock to split? Can you give any, shed any light on that?
There's different reasons, of course, like there's not one answer. One major reason why a company might do that, so like Amazon just split, Google just split, Apple likes to split sometimes. So when that happens, right, so now they've got more shares that are available, but at a lower price. So that invites more potential investors, because there's this mental thing as human beings that like, you don't want to buy like a half a share of something, right? You want to own like a whole share, right? And so, Amazon at like 3,000, well, it's not anymore, but like, it was $3,500 a share previously, $3,700 a share. Well, gee, that's a whole lot of money for some people to just put into one share of stock. And who wants to own just one share? You want to own like 10 shares or like 100 shares. Like, that's more fun, and how is one share going to go up? It's only one. So there's like this mental like factor in it, and companies know that. And so, all of a sudden, Amazon is now, $124 a share. Well, gee, that's a lot more affordable. It's a pair of sneakers.
So it's marketing basically.
In some cases, yes.
In some ways. Okay.
In some cases, yes. That's kind of the most straightforward reason. It's not, again, all of the reasons, but that's one of the most straightforward ones behind it. It's just a mental thing. Marketing gets you every time, doesn't it? It really does. It's amazing what they've tricked us into believing. Yeah. Scott, do you have a question? I'm just thinking.
Well, what do you think about inflation, where we're going this year? It's like 9.1 now.
It should moderate towards the end of the year. Should moderate. I mean, why? Because, if you give things long enough time, the supply chain is going to sort itself out. We've seen a little bit better manufacturing uptick coming out of China. They tend to manufacture a lot of our goods across the world. And so we've seen an uptick over there. So that should have the trickle-down effect that, things are working themselves out. That doesn't mean it's going to go away. We don't think by the end of the year that it's all of a sudden going to be at pre-pandemic inflation levels. But we do think it's going to moderate by the end of the year. The Fed might, if all of the stars align in a nice way, the Fed maybe would put on the brakes to raising rates. But we don't see that as like the most likely outcome. We're just hoping that they slow their roll basically on that. But we just have to continue doing our part and continue to spend, right? GDP is 70% on consumer spending. But, all of these factors, should it change the way that you're functioning in your day-to-day, other than just taking a look at like where your money's going, period, it really shouldn't affect like overall what you should be doing, in your life, other than you just increase your awareness, right? Just see where your money's going, how much is going where. We don't see inflation getting to the point where it's going to affect personal income through the rest of the year, which is a positive thing. Now, are we going to go into recession? People like to ask me that question again. Well, I don't know. If you can't even make the decision, like if the people who determine if it's a recession can't even give you like some actual information as to how they determine it, then I definitely can't. I will say that like some of the economic indicators are showing, more of that being a potential than it did last quarter. That doesn't mean it's going to continue heading that way though. So it's still on the table as it could happen, but it's not like 100% or even 90%, right? As we saw at 70% fair market.
It's always a look back anyway, so
Right.
It won't be until next year before they say, oh yeah, by the way.
Yeah, it's usually after like a quarter ends, because then they can analyze all that quarter's data relative to the previous. And then you need at least 2 quarters to have a large enough data set for them to analyze. That's why it's often associated with 2 quarters back to back of declining economic indicators, right? Because oftentimes that is part of, when a recession is declared, but it's not always. So it is the look back. So after each quarter, give it, I don't know, 2 to 3 weeks, maybe a month, then we'll know if we're in one or not. But yeah, so if you think about it this way with inflation too, how many people refinanced a house or purchased a house and you got like a pretty darn good rate?
Everyone that uses it.
Right, this is relevant, right? Okay, so you've got some pretty good cost savings there, potentially, right? Potentially. So that money that you've like saved, well then now all of a sudden now you're just spending it on your, filling up your gas tank.
Right, yeah.
So like things tend to just, the money is still being spent somewhere, it just maybe isn't being spent where it was 2 years ago. So that just brings me back to check in on your own budget periodically. I run my own budget once or twice a year just to make sure, number one, that I'm not paying for some random subscription service that I forgot I even signed up for or didn't realize I signed up for. Thanks, Apple. And two, just to make sure that like all of a sudden, I don't know if any of you have noticed, like on a Verizon internet bill or a Comcast bill, all of a sudden your internet is like ticked up little by little. Like, what is that? Like, what is that, right? So there's certain places where your money just will creep up without them like really even saying anything, or at least you're not noticing. So just check in on your budget once or twice a year, see where the money's going. Being aware, you'll subconsciously actually make better decisions. Yeah, it's a little phenomenon.
Lindsay, I have a 2-part question here. And going back to the dividends and the stocks, that's not the only determining factor I use in picking them, but I do tend to go to the ones where I research it and I see if they pay out dividends. And is that a good idea? Is that a good factor I should be using? And then also the ones that I do have, I don't have it where it's like being paid out. I have it like in the drip system where it gets reinvested into that stock to purchase fractions or whatever it can purchase. Is that what I should be doing?
So it depends on the company. I mean, if you want to own companies in which during their prices are going down, you're still getting paid, that's one piece of the puzzle, right? The only thing to be cautious of is missing out on companies that are going to grow outsized compared to maybe dividend paying companies, right? So dividend paying company, you're getting paid in different ways. You want the price to go up. It should go up over time, of course, but I wouldn't expect it to go up as much as maybe a growth type of company. So that's where the whole diversification thing comes in. But if it's giving you what you need it to give you at the same time, again, that goes back to the purpose of the money, then that's fine too, right? You can just have the dividend paying stocks as long as they're giving you what you need. But if they're not giving you enough growth, if your portfolio investments are not growing as much as they need to, then you need to take on a little bit more risk and go with the growth stocks. And the reinvestment part, well, compound interest is the 8th wonder of the world, right? So that's essentially when you're reinvesting that dividend, you're adding to the principal more dividend than increasing because you're getting more shares. So as long as that company is still one that you want to continue to buy into, then yeah, reinvest the dividends. Having things on autopilot, as I'm sure many of us in this room have found, as long as it's like an autopilot to, the positive side of things, right? That's a good thing, right? It's one less thing to think about. If you can remove yourself from the equation, a lot of times that's to your benefit when it comes to, investing and saving for the future. Just having it on autopilot, not even having to think about it. That doesn't mean you have to ignore your investments, right? Investments in your portfolio is not an autopilot thing, but setting up like a monthly or even like a quarterly, money goes and gets invested is good. Yeah. You're also taking price out of the equation. So dollar cost averaging, DCA is the shortened version. That means that you're buying in at the average cost, the average price that an investment is over a year's time. So if you're putting money in once a month over a year, right, and you put money in 12 times, versus if you put money in, just twice that year, well, you're going to get the average price of just those 2 purchases versus the average price of 12. So if you run that out long enough, getting the average price is pretty darn good. Then you're not buying in when it's highest, you're not buying in when it's lowest. You take that out of the equation too. So that's a solid way to set yourself up for success too, because life happens, right? And you can't just all, like, every single month of every single year, oh yeah, I've got to send X dollars to so-and-so to invest, right? Just have it set up automatically. Yeah. What else? Nobody's asking about Social Security? Is it going to be here?
It's gonna go up.
Is it going to go away?
I figured we just wouldn't have it.
It's not going to go away.
Oh.
It's not going to go away. We have to make some decisions in order to preserve, the value to stay there. But as with anything in life, right? Like hard decisions, easy life, right? Easy decisions, hard life. So they're hard decisions that Congress has to make in order to, and it's not like necessarily one decision either that will preserve our Social Security fund to be there. It's probably going to be a couple of ways they're going to have to change numbers, maybe increase payroll taxes is one idea floating around out there. So none of the options are favorable, of course, because if they were all favorable, like it would have, like that choice would have been made already. They would have just done it and fixed it. So none of them are like favorable, but it's fixable is the moral of the story. So,
What's it coming on that?
yeah. So like, I think there's 83% of recent retirees still believe that Social Security was not going to be there. It is. Yeah, if you think the people of the United States of America are going to let Social Security go down, Congress will vote. They'll wait to the very last minute to fix it, but they'll do it. Yeah, naturally, as is indicated by prior decisions, they will wait until the very last moment, the midnight hour, but it'll be fixed. Yeah. So you should count on it. You should factor that into your
That
vote.
is comforting.
I've never been worried about it because I have access to all the data. Right? As with anything, if you're worried about it, it's usually because you don't understand all the things associated with it just yet, or maybe you do, and that's why you're worried. But in this case, if you just educate yourself, take a minute to dig a little bit deeper into some of these, larger worries. I call it fear setting. Go through all your fears and dig deeper and figure out, why are you actually scared of that? Is it because you don't have enough information? Is it because of something else that you can change your attitude, right? You can make a different choice. But usually there's a solution to all of these fears that we have.
I get blasted on emails as firm like Motley Fool, all those. What's your feeling on those types of advisory literature?
I don't remember what % of their revenue comes from marketing, but it might be 100. That doesn't mean they're sharing bad information or inaccurate information either, but like they get paid by the people who advertise with them, like on their website.
Right.
And you'll see like the different companies that will advertise, like that's how they make money. And so like they're incentivized to put out good information because, as somebody who wants to advertise with them, you don't want to put your name associated with the company that like doesn't know what they're talking about.
Right.
So it's not necessarily that like Motley Fool or what is the other big one that I can't think of right now? Yeah, it's a little different, but yeah, it's Motley Fool and
That's the biggest one that I see.
gosh, there's another one though. I can't. Either way, but yeah, it's I'm pretty sure it's either 90 or 100% of the revenue comes from paid advertisements.
Does a lot of that too.
What did you say?
Inman,
And we connect.
there's all
There's so many out
of
there.
follows too.
So yeah, but again, so it's like with a grain of salt, right? You want to see how they make their money, and just to discuss while we're on the topic. So Edward Jones is not a publicly traded company, and the only way that we earn revenue as a company is through working with our clients. So if our clients all of a sudden stop doing business with us, then we don't have revenue. Right? So that is literally all we do is we help individual investors, small business owners invest their money for whatever it is the goal is.
And how do you get your models? Where do your models for investing or advice come from to pass on to your clients? Where do you?
We have an investment policy committee, and their sole job as a committee is to look at what is going on in our markets and the economy and determine based upon what somebody's comfortable with and the goal of the money, ranges of which we should be positioning their money. And then further on down the line, we have research departments in equities or stocks, bonds, mutual funds, ETFs, you name it. All of our research departments then narrow down the whole universe of what's available to invest in for us to choose from for our clients. So we don't design our own investment products. We use everyone else's because that is their core competency, not ours. Our core competency is putting all the pieces of the puzzle together and working with our clients. So I tell people, like, my job is to be an expert in you as the individual. And I know enough about investments to be dangerous, but we've got access to, we've got 50,000 employees at Edward Jones. We've got departments that specialize in Social Security. For example, employer-sponsored retirement plans. That's a mouthful. That means 401k, SEP IRA, if you've heard of it, simple IRA, if you've heard of it, defined contribution plans, right? So we've got departments that is their only job is to specialize in those particular. We've got our high net worth client consultation group for our clients that have $2 million or more in investable assets. They can sometimes have more complex needs just depending upon the situation. So we've got our client consultation group that helps me support the client needs in that case. Offering private stock to employees, how to go about doing that, things like that. So, yeah, and again, I mention that because it's important to know who you're working with, where the company generates revenue from. I'm not going to call out some of the other financial firms, but a lot of them are publicly traded. Therefore, they've got to pay attention to their shareholders, right? So they've got to do certain things so that the shareholders remain happy. Because if you're publicly traded, that should be your primary, it's not always with every company, but it should be, their primary driver of where they're going to get growth, paying attention to the people who have invested their money in them. So, yeah. The Motley Fool. They've got some good articles. They're analysts. They get, some companies will actually pay them to write a report.
Oh, really?
Yeah, because the company wants to get press. They want to get information out there, and they know that Motley Fool, like, a lot of people read it, and they do. And so Motley Fool will, do an analyst report for a company because they might have been paid to do so. And if you watch, it's really fun. So you can watch what article or what company Motley Fool just talked about, and then you watch the volume increase in how many shares were traded the next couple of days. A little fun little pattern to look at.
Insight there.
Yeah. Yeah. Just, nerdy things that I do. that you learn over 12 years. Cool.
Well, awesome, Lindsay. Thank you very much. You guys, thank you very much for coming.
Yeah.
Everybody got lunch, right? We're going to wrap it up for now, and next month we'll have another series. But thank you very much, Lindsay, for bestowing all your knowledge upon us.
All of the knowledge, you just got all of it.
All of it. She just downloaded her entire database.
Yeah, thanks for having me. Yeah, appreciate it.
Thank you guys. If you guys have any questions that
Yes,
are
ma'am.
watching online, get back to me.
I'd just like to thank Lindsay, because I had a financial advisor doing anything for me. I wasn't in my retirement stuff, and so I transferred to Lindsay, and she got in there and dug out everything, and dug in stuff, and so now I'm happy. That was
Yes.
so I'm glad I switched.
Aw, thank you,
job. Nice
Angela. I
testimony.
did not plant her here. I did not know she was coming. But I always appreciate her.
Yes. So if you guys have any questions that come up, please just send me an email and I'll get to Lindsay and make sure that we get your questions answered. And that goes for everyone here and everyone online as well. So I thank you guys very much for coming. Please stay, enjoy, check out the facility. If you guys can't, you should have been here. But it's awesome. So thank you guys.
Thank you.
Did I end it?